All right. Well, the two things they say never to talk about is death and taxes, and we're going to break the norm and talk about the taxes here, right, Rick?
That's right, Lisa.
All right, very good. So I'll have you take it away. We're going to talk a little bit more, continuing our series about how we want to help frame this franchise world to our investor candidates that we work with.
Thanks, Lisa. Let's look at that first slide. If you've missed some of the earlier sessions, we kind of highlight three principal reasons why we think people should look at franchising as an investment strategy. Unlike a lot of other types of investments, when you invest in a business, you have complete control over it. And that is extremely important. You also are partnering with a group of very experienced owners and operators. And so if your businesses are aligned, you really are partnering with experienced people who are going to help you. One of the big reasons is compared to like perhaps long-term investments in stocks and bonds, the rate of return you can earn on your investments are much higher in a business. In some cases, maybe 15 to 30% or more. But one of the real reasons that, and one that we're going to cover today, is the government through its tax policy really helps business owners in a number of areas. And we think this is extremely important to understand if you're looking at this strategy. But before we begin to look at the tax aspects, let's just refresh ourselves on how wealth is really built. And Lisa and I have kind of defined wealth building as trying to build enough accumulated wealth to where you can live comfortably in your retirement and you've got money that you can leave to your heirs or to charities. And so because retirement is such a key component of that, with a little bit of refresher, we're going to cover some things that we covered before, but integrate taxes into this. In earlier sessions, we talked about compound interest, and probably everybody is generally aware of how that works. This chart just shows how money would double over time. And the rule of 72 just says that if you have a beginning balance and you're earning 6% on that balance, that it would double in 12 years. Contrast that with if the money was invested at 12%, it could double in 6 years. And this doubling impact on your money is key to really building your wealth. Now, I'm not a lawyer, I'm not a tax accountant. And so today's session, we're really not giving advice as much as I'm trying to alert you to some of the business and income tax benefits you might explore with your own tax accountant or your attorney in looking at this. In my experience on this next slide, most of the opportunities to save money is in tax deferral, not so much tax avoidance. But this chart shows how big of an impact it can be on your savings. And what this chart does, it takes two funds, one on the left that is tax-free, like in a retirement account, and the other on the right that is in a taxable account where you're paying taxes at 25% a year. And they've kind of used, just to illustrate how big the impact, they've assumed that the money doubles 20 times, which is unrealistic in a lifetime, but it does illustrate the impact. But you can see year by year, there's smaller balances on the right because you're paying the income taxes. And if you see it over 20 doubles, it has an enormous impact, 72,000 versus $1 million. So again, this is exaggerated just to illustrate it, but the sheer fact of not paying taxes year by year has a huge impact on building your wealth and your retirement savings. Lisa, does this surprise you? I mean, you've been a business owner for years. You probably definitely understand the importance of not paying taxes, but does it surprise you how impactful it can be?
It's definitely impactful. I mean, I think anyone in business knows we're always trying to, like you said, defer it or just be aware of the tax advantages of being a business owner, which I think is important for this conversation. Sometimes it does get forgotten, but there are some, there's some good government loopholes out there for us to take advantage of. And I think this number is great as it lays it right out there, what it's going to look like for people. So I think it's a good conversation.
Thank you. I think most people, when they think about income taxes, they understand the value of deferring taxes, as we just covered. And they understand, like, if they're saving for college, using the Section 529 plans are very effective. Using 401ks are very effective. But a lot of people don't realize the impact. And the chart we just showed illustrates how the money can accumulate in the fund and avoid taxes. But let's just spend a little time just focusing on the tax deduction for retirement. And the reason, again, I focus on that is because that's such a big element of your wealth building strategy. So if you're putting aside, let's say, $12,000 a year for your retirement, and you're in what's called a marginal tax rate of 33%. That means that's the highest tax table that you use to find your taxes. The government, in essence, is giving you a $4,000 benefit that's helping you fund your retirement. It's like a tax-free accommodation that they're making. So what's happening is you're taking the deduction. You're not paying about $4,000 in taxes you would otherwise pay on your income, and you're depositing in your retirement account. The other thing that's happening is by not paying interest, or not paying taxes, on the interest as it earns, you're also getting like another 1 to 2% contribution in your earnings account. So your yields are higher as a result of that. But let's look at the question of, can you do more if you own a business? Maybe this next slide will begin to illustrate that. In the area of retirement savings, if you've heard me talk before or read some of my observations, I'm personally very concerned about the chronic underfunding of retirement. It's something that probably began when in the United States we went from defined benefit plans, the traditional pension plans, to defined contribution plans. And that, combined with the rates of return that you can earn in the stock market, is just causing this dramatic underfunding. What this chart shows is if you're in the top 10% of income earners and you're making $160,000 a year in income, you're going to need a retirement fund that's in the range of 1.6 million. And on the right, you can see the actual fund that most of the people have at that level. And so if you're in this situation, I almost hate, Lisa, to show this kind of chart to people, because I'm not trying to scare people or alarm them, but it's something that I honestly don't think there's many people in the country, different professional groups, that are really talking about this. I don't find it true in the financial advisory services necessarily. And, I don't know if the tax accountants are talking about it, but this is a substantial issue and one that people really need to focus on. And business ownership could actually be one of the very viable solutions to this. What are your observations about this in talking with your candidates?
No, absolutely. I think, we tend to deal when we're talking with our investors. They know that they need to diversify their income is usually the words that we'll use to talk about possibly keeping their current position and adding business ownership. Why would you take that risk? Why would you take that step? Why would we be having this conversation? And I think it is income diversification, but when you take it a step further, the reason they are talking about diversifying their income at 50 years old is because of this conversation, without possibly, being able to get it out, which I'm having a problem with my words right now too. But I think that that's part of it, is that they know they're not ready. They don't necessarily know why, and they know they've done okay, but they've got to figure out another way to pad that retirement nest. And that's what the income from a business has the potential to do.
That's right, Lisa. So you can see on this chart, there are some people that are way behind in their retirement savings. And if this is you and you're concerned about this, one of the opportunities to catch up is really through business ownership. And that's what we're going to discuss next. A business owner, unlike a corporate employee or a private individual, when they set up their retirement plans, they can actually set up what's called a self-employment plan, an SEP. And in those cases, they can contribute as much as $60,000 a year in retirement. and take the tax deductions compared to $22,000 a year if you're part of a corporation. So just imagine what the impact could be if you're deducting as much as 3 times as much in your business for your retirement. I mean, you can substantially accelerate your retirement savings. But rather than look at a 3-to-1 growth, I just put some numbers together just to illustrate this. And let's say that you simply were putting $22,000 a year in your corporate plan, and you tried to set up an SEP, and you tried to raise it to $3,000 a month, or about $36,000 a year. That corporate plan would only grow to $750,000 over 25 years. And so again, if you're in one of those situations where you may be as much as $1 million underfunded, that's getting there, but it's not fully allowing you to fund enough for your retirement. By just increasing your monthly contributions by, I think it was $1,200 in my example, it took you all the way from $750,000 to $1.3 million. And that's at 6% return on your money. If you could go to $4,000 a month, it takes you to like $1.8 million, which is probably adequate for many people's retirement needs. So there's a great benefit to owning a business where you set up your own retirement plan for your business ownership and start contributing at higher rates. But what if you could invest at higher rates of return than the 6 to 8%? What if you could invest in your business and the business could grow at 15% tax-free? It may be hard to believe, but that actually exists. Let's look at this next slide. The government actually allows people that want to start a business to fund it with their existing retirement plans. So if you have a retirement plan that has, let's say, $300,000 in the plan, you can actually take that money, roll it over into what's called a ROBS plan. It stands for a retirement business startup plan. It's a rollover, so it's not taxable to when you take the money out of your existing plan. You actually then have the new plan invest in the company, buy the stock or however you set up your company. And just think about this. If you start making 15 to 30% a year, that becomes the investment returns in the pension plan. So not only do you have the ability to set up a new plan, a set plan that accelerates how much you can contribute, but you can also have the actual company as it grows be retirement assets for you. So it's almost like you've heard of self-directed plans where you can own stock where you can own gold or silver. This is like a self-directed plan where you own the business. And so the growth that can happen in your retirement account is just incredible. And probably the best news, I think, is depending on what your objective is, if you end up selling the business later, most people, when they get into a business, they think about their exit strategy, and they realize that if they build a successful business and it's earning year over year earnings, that it can actually be sold for a premium. If those proceeds are rolled back over into the retirement plan, it's not taxed. And so again, you can escape capital gains tax treatment that would otherwise come out of your assets and have them kind of compound in that tax-free account and grow that much faster. Let me just pause there and let that kind of sink in for a second, Lisa. Have you seen this plan, this approach used with some of your members?
Often. I'm definitely not the one to explain it to people, so we refer them to one of our million, right, different partners that are able to explain this, the Benetrin, Fran Fun, Guidance of the world. We do have some independent guys that can do that without maintenance fees, which is always interesting to look at. And funny enough, Rick, this is how we funded our business. So we rolled over some SEP and we used it, and we're now funding that business with some SEP and then able to add that business to our portfolio in order to save for retirement faster. It's not necessarily just a cash flow play in your mid-50s. It's also use that cash flow, build that asset, and then be able to set more aside for retirement.
Yeah, I think everybody hopefully realizes that when you invest in a retirement plan, the monies are somewhat restricted. If you were to pull them out early before retirement, you pay taxes and actually a penalty on the funds. So this would not be a strategy if you felt like you needed the money for living expenses. But if it's something that you're trying to accelerate your retirement, it's a huge opportunity to do just that.
Absolutely. And I mean, definitely keep in mind, everybody out there, that we will connect you with people that can do this legally. I mean, essentially, you can't do it on your own. And if you want to pull it out and buy a Mercedes, you're going to pay about 30% penalty to use that money for personal use. But you roll it into a small business, and the tax and penalty free part becomes very interesting.
If you think about those charts on the rule of 72 and just the whole idea of compounding interest, if you're compounding it at 15% or 20% or whatever the return is versus 6%, it grows so much more over that 15-20 year period.
Absolutely.
So the last category of types of benefits is really kind of related to how you form your business. When you put your business together, you'll be asked to come up with an organizational structure. You could do it in the way of a sole proprietorship, a limited liability company, a partnership, or C corporations, and they all have different tax treatments that, again, we highly recommend you talk to your tax advisors and your legal advisors about this. And a lot of it's going to depend on your strategies. But one of the things that is really interesting about how you set this up is that the LLCs and the partnerships, for example, are what we classically call pass-through organizations. They do not pay separate income taxes to the federal government. An information tax return is prepared. You've probably heard of K-1s being issued by a partnership. So the partnership would send you something that shows what your taxable income is, what your deductions are. But what it introduces is the ability to kind of blend your business expenses with your personal expenses and deductions. So just think about it. One of the benefits of owning a business, and I think most people realize this, is depreciation, and the fact that you're allowed to deduct a non-cash expense that really kind of reflects the intended use of your business asset through your business. Well, another tax policy that's very favorable is you can take very aggressive deductions for depreciation. And so that's something you should talk with your tax advisor. But let me just give you an example. If you take aggressive deductions in the business side and it causes losses in your personal return, it's basically sheltering some of your personal income. And again, deferring taxes, which is, again, a key strategy in building wealth. If it's so substantial that it, like in a brick and mortar opportunity, you may create enough deductions to actually create the opportunity to go back and claim refunds by amending prior tax returns. And indirectly, that could be a funding source for your business. So I'd say early discussion with tax people and careful planning are very important, because it really kind of depends on what you're trying to achieve in your business. Are you trying to accelerate your deductions, which will end up causing higher capital gains? But if you've used the Rob's strategy, for example, those just get rolled back over into your retirement plan. So careful planning is very, very important. The final category is probably just, there are some assets that have kind of a dual purpose, both business and personal, and you can partially deduct those in your business. And so talking with your attorneys and tax people about how you set your business up, whether or not you consolidate these returns and your personal returns and all of that, is very, very important and can have a substantial impact, again, on building wealth. So in summary, businesses, and specifically franchises, offer the opportunity to earn higher returns on your investments. However, when you use these tax policies that we've been talking about to your advantage by collaborating with your business advisors, you can substantially impact the growth in your personal wealth at the same time. So it's like it gives you a separate set of things to capitalize on the business, not just the business, but the taxes that are generated by the business, how fast it grows, your pension assets. And so even for the investor, or even for the investor that stays employed and is a semi-passive owner of this business, we highly recommend that you talk early with your tax accountants and your legal advisors and do a good bit of planning about how to fully take advantage of these benefits.
Absolutely. I think it's important to say at this point is now we're going to start getting into some of those business opportunities that make sense. And when we talk about investors, I think some people think Warren Buffett, right? That, okay, once I have $1 million, I'll be able to think like that. And we're going to look at businesses that are window washing. We're going to look at businesses that are simple, IV drip bars, anything in the medical space. You know, unless you're a doctor, you're hiring. You're not necessarily in there doing the work, that makes you an investor in that business. So I think the next couple of discussions will really bring all this together and make people understand it doesn't have to be a hotel. It can be something a little bit simpler, and you can still be an investor and capitalize on all of these advantages.